month, the sterling advanced to its highest level in a year against the Swissy. However, recent trading patterns are starting to reveal that this gain was possibly too extreme. The pound rose to more than a 2-month high against the Swiss franc. On Friday the 16th of August, option traders paid the largest premium in nearly 6 months to purchase the sterling against the franc. According to Bloomberg correlation-weighted indexes, the sterling achieved its greatest monthly rise since September 2011. It increased to 3% against the 10 major currencies. This was boosted by the fall in unemployment claims in July. Mike Moran, a senior currency strategist at Standard Chartered in New York, said, "The data has been very supportive for sterling. It's been much stronger than the market gave it credit for." In the second quarter, the unemployment rate stayed at 7.8%. The Bank of England Governor Mark Carney stated this month that the bank would not increase rates until the unemployment figure drops to 7%. Last week, Michael Schneid, a currency strategist at BNP Paribas in London, shared his views on the strength of the currency. He stated sterling's rise looks far too extreme, so we expect some unwind of the overvaluation of the pound. We would expect a decline as investors unwind some of that over-optimism that they've priced into the currency. He expects that the BOE in the future will repeat that if it needs to, it will loosen monetary policy, cut rates, or even implement quantitative easing. Krishna Veer, a currency strategist at Gain Capital in New York, believes, "We're definitely catching some pretty critical levels, a solid resistance zone. This is the kind of make or break level, where if people think sterling is too strong, they might try to fade it." The pound's rise has not put off FX strategists, as many have actually raised their outlook for the pound against the euro, as they believe it will overtake that of continental Europe. Last week, future traders also placed their bets that European rates will actually increase slower than the UK rates. Hans Redeker, the London-based head of global foreign exchange strategy at Morgan Stanley, said, "Money markets only come in if they think sterling is trading at a low enough level to protect themselves against potential currency losses. They fear money market flows are not going to come in, so we could see sterling back under selling pressure." According to data from the IMF, the UK has a current account deficit of 4.3% of GDP. The Confederation of British Industry expects UK GDP to actually reach 1.3% this year and 2.3% in 2014. Well, viewers, that is it for today's press review, but if UK economic news interests you, then make sure you tune in on Friday for Thomas Taplin's coverage of UK GDP. But for now, goodbye.